It already broke. By the time most traders noticed the green candle, the hidden signal had already played out. XRP pushed through resistance with a calm precision that didn't feel emotional. No euphoric spike, no chaotic liquidation cascade, just steady pressure building until the ceiling gave way. I was watching the order books when it happened. The sell walls that had rejected price for weeks started thinning out, not disappearing all at once, but getting absorbed piece by piece. Large bids stepped up quietly, not aggressive, not desperate, just patient. And here's what bothered me. There was no headline from Ripple Labs, no dramatic update from the US Securities and Exchange Commission, no viral narrative explaining the shift, which means this wasn't reaction, it was positioning. Then I saw it. The hidden signal most retail traders never track, a subtle divergence between exchange reserves and price compression that almost always precedes expansion. By the time social media started asking, "Is this the breakout?" the real move was already underway. Give me 8 minutes, because what I'm about to show you suggests this breakout wasn't random, it was prepared. And if you miss this signal, you won't just miss the move, you'll become the liquidity behind it. When XRP finally pushed above resistance, it didn't feel explosive. That's the first clue. Explosive breakouts are fueled by emotion. They come with spikes in funding rates, aggressive leverage, and vertical candles that look unstable. This wasn't that. I noticed funding barely moved. Open interest climbed slowly. Spot volume led derivatives. That's rare. When spot leads, ownership changes hands. That means someone wasn't renting exposure. They were accumulating it. The breakout occurred during a low attention window. No macro shock, no surprise announcement, just structural pressure building until supply thinned out. Markets don't randomly decide to break levels that held for weeks. Something shifts underneath. And the shift wasn't visible in headlines, it was visible in behavior. Behavior always precedes narrative. Here's the hidden signal. While XRP was compressing in a tight range, exchange reserves were slowly declining, not dramatically, not enough to trend on analytics dashboards, but enough. When coins leave exchanges, immediate sell pressure decreases. That doesn't guarantee upside, but it changes the liquidity equation. At the same time, volatility was shrinking. Tighter candles, smaller wicks, fewer aggressive sell-offs. That combination matters. Reduced supply on exchanges plus compression, potential imbalance. It's like pressure building inside a sealed chamber. Retail sees boredom, smart money sees opportunity, and once the available supply becomes thin enough, even moderate demand can trigger expansion, which is exactly what happened. I checked large wallet movements during the compression phase, structured transfers, consistent sizes, spaced out over hours. That's not panic, that's planning. Whales don't accumulate vertically, they accumulate horizontally. They build inside ranges where price movement is minimal and attention is low. What stood out was the absence of large exchange inflows before the breakout. If this were distribution, supply would move on to exchanges ahead of a push upward. Instead, reserves tightened. That suggests confidence, or at least reduced urgency to sell. And confidence at scale creates structural support retail can't see in real time. Every XRP move exists under regulatory shadow, but recently I noticed something subtle. The tone around regulatory discussions has stabilized. No sudden escalations, no dramatic setbacks, just procedural movement. Markets don't wait for absolute clarity. They reprice based on probability shifts. If institutional participants believe the legal environment is becoming more predictable, even slightly, they adjust exposure, not loudly, quietly, and quiet adjustments create hidden floors in price action. This breakout didn't feel like speculation, it felt like repricing risk. After the breakout, I expected a violent pullback. Instead, I saw shallow retracements. Dips were absorbed quickly. Order books refilled. No cascading liquidation events. That tells me leverage wasn't driving the move. Because leverage-driven breakouts collapse fast when momentum stalls, this one held. Stability after expansion is rare in emotional rallies, but common in accumulation-driven shifts. That's a key distinction. I watched sentiment during the move. Confusion, skepticism, caution. Probably another fake breakout. That skepticism is powerful. Because when retail doesn't fully believe the move, they don't overcrowd it. And overcrowded trades are fragile. This breakout didn't feel overcrowded, it felt under-recognized. Under-recognized moves tend to extend further than expected because positioning remains incomplete. Zooming out, I noticed something critical. XRP didn't just break resistance, it flipped it. That former ceiling, the level that rejected price again and again during uncertainty, stopped acting like a barrier and started behaving like a floor. Every dip toward it was met with bids, not dramatic spikes, not desperate buying, just quiet defense. That's not cosmetic, that's structural evolution. There's a massive difference between price temporarily wicking above resistance and actually reclaiming it. Wicks are emotional, reclaims are intentional. When a level flips from supply to demand, it signals that the sellers who once controlled that zone have either exhausted themselves or been absorbed. And absorption changes everything. During long compression phases, supply gradually transfers from impatient hands to patient ones. Weak conviction sells into boredom. Strong conviction accumulates without urgency. Over time, the available inventory sitting near resistance thins out, so when price finally pushes through, there isn't enough overhead supply left to force it back down aggressively. That's why sustainable expansions don't start with fireworks. They start with quiet reclaims. Markets that reclaim key levels after prolonged consolidation often enter expansion cycles, not because of hype, not because of social media enthusiasm, but because the structural imbalance has shifted. Demand outweighs available supply. And that imbalance doesn't scream, it builds. This wasn't random volatility. Random volatility leaves chaos. Long upper wicks, violent reversals, unstable structure. This felt different. This felt like transition. Like the market quietly stepping from one phase into another, from compression to expansion, while most participants were still arguing about whether the ceiling would ever break. The real shift wasn't the breakout, it was the defense that followed. And defense is what turns a move into a trend. So, what was the hidden signal? It wasn't one dramatic event. It wasn't a surprise announcement from Ripple Labs. It wasn't a sudden shift in tone from the U.S. Securities and Exchange Commission. It was convergence, shrinking exchange reserves, volatility compression tightening like a coiled spring, a breakout led by spot buyers, not over-leveraged derivatives gamblers, shallow retracements that refused to break structure, funding rates staying stable instead of overheating. Individually, each of these signals is easy to dismiss. On their own, they don't trend on social media. They don't trigger instant FOMO. They don't scream massive move incoming, but together, they form a pattern of preparation. When supply quietly leaves exchanges, when price compresses without collapsing, when breakouts are supported by ownership rather than borrowed leverage, that's not chaos. That's inventory changing hands, and inventory transfer is what precedes expansion. Here's the warning. If you wait for a loud catalyst, a headline, a regulatory breakthrough, a viral narrative, you'll miss quiet accumulation. Because by the time the catalyst is obvious, positioning is already complete. If you trade based only on headlines, you're always reacting to moves already funded by someone else. XRP's next breakout won't feel obvious at the start. It will feel suspicious, uncertain, maybe even temporary. That's how real structural shifts begin, under disbelief, not celebration. Markets reward those who track structure, not emotion. So give me 8 minutes of your attention. Study exchange flows, watch volatility, observe how price reacts to dips. Watch the footprints, not the noise, because the next expansion won't ask for permission. It will simply reveal who was paying attention and who was waiting for confirmation that came too late.